January 11th, 2026. This date isn't just another square on the fiscal calendar. It marks the moment the United States crossed a line from which there is no historical precedent for a graceful return. As of this morning, the national debt stands at a staggering $38 $4 trillion, but the number itself isn't the headline. The headline is the cost of carrying it. For the first time in the history of the Republic, the annual interest expense on that debt has sustained a run rate of $1 trillion. To put that into perspective, we are no longer just borrowing to build, to defend, or to grow. We are now borrowing simply to afford the right to keep borrowing. This is the reserve currency cycle entering its most volatile phase. Here is the part most people miss. Most analysts focus on the debt-to-GDP ratio as if it were a static measurement of health. But for those of us watching the plumbing of the global credit system, the only metric that matters is the marginal financing conditions. This refers to the cost of the very next dollar the Treasury needs to raise. When your interest bill hits $1 trillion, the marginal cost starts to cannibalize the core functions of the state. Receipt 1. According to the latest CBO debt projections released for the 2026 fiscal year, net interest outlays have now officially surpassed the entire defense budget. This isn't a forecast, it is the current burn rate. To visualize the spoken impact of this math, roughly 22 cents of every tax dollar collected by the IRS is now vaporized by interest payments before a single road is paved, a single soldier is paid, or a single Social Security check is cleared. We are witnessing the interest spiral move from a theoretical risk to a primary macro constraint. The issue isn't the debt stock, it's the refinancing treadmill. The U.S. Treasury doesn't just pay off debt, it rolls it over. Every week, billions of dollars in older bonds, issued when rates were near zero, mature. The Treasury must then issue new bonds at current 2026 yields to pay back the old ones. This is the rollover behavior that is currently resetting the entire cost structure of the U.S. government in real time. Historically, when a global power reaches the stage where interest payments consume more than 20% of its revenue, the reserve currency cycle dictates a shift in official sector behavior. We are seeing it now. The world is watching to see if the United States can maintain its duration risk, or if it will be forced to devalue the currency to stay solvent. If you think this is a partisan issue, you're looking at the wrong map. This is a mathematical trap. The marginal financing conditions are tightening because the pool of willing lenders is shrinking, just as the need for cash is exploding. The $1 trillion interest threshold is a psychological 0 hour. It signals to the primary dealers and global central banks that the refinancing treadmill is accelerating beyond the speed of organic economic growth. When the cost of the past becomes greater than the investment in the future, the system enters a period of fiscal dominance. In this environment, the Federal Reserve's mandate to control inflation becomes secondary to the Treasury's need to stay liquid. This is the quiet signal the market has been waiting for. But while the headlines focus on the $38 $4 trillion total, a much more dangerous shift is happening in the shadows of the bond market. Specifically, who is suddenly refusing to show up at the auctions? While the $1 trillion interest threshold captures the public's attention, a more significant structural shift is occurring in the plumbing of the global financial system. This is what we call the quiet signal. To understand why marginal financing conditions are tightening so aggressively, we have to look past the Treasury's press releases and into the data regarding who is actually buying, and more importantly, who is selling U.S. sovereign debt. For decades, the global financial architecture relied on a predictable recycling mechanism. Foreign central banks, primarily in Asia and the Middle East, would earn dollars through trade and immediately reinvest those dollars back into U.S. treasuries. This created a reliable liquidity backstop that kept yields low and the dollar dominant. That mechanism has effectively broken. Receipt 2, the latest TIC flows, Treasury International Capital, data reveals a sobering trend in rollover behavior. Over the last 12 months leading into January 2026, we have observed a consistent net divestment from long-dated Treasury securities by the official sector, the foreign central banks and sovereign wealth funds that once formed the bedrock of the market. While they continue to hold short-term bills for liquidity, their appetite for the 10-year and 30-year bonds, the instruments that fund long-term government operations, has reached a decade-level low. What we are witnessing is a silent repatriation. Foreign capitals are no longer willing to underwrite the U.S. duration risk at these levels. Instead, they are pivoting toward domestic priorities or hard assets. This leaves the U.S. Treasury in a precarious position. When the world's largest buyers step back from the table, the burden falls on primary dealers, the massive domestic banks that are legally obligated to bid at Treasury auctions. But here's the part most people miss. These banks do not have infinite balance sheet capacity. as they are forced to absorb a larger share of the $4 trillion debt. Their ability to provide credit to the private economy diminishes. This is the crowding out effect rendered in institutional ink. The reserve currency cycle dictates that as the hegemon's debt grows, the official sector abroad begins to prioritize physical settlement over paper claims. We see this reflected not just in the TIC data, but in the rising premiums for physical commodities. The global credit system is beginning to treat U.S. debt not as a risk-free asset, but as a duration trade that requires a higher and higher risk premium. In professional circles, this is discussed as a shift in the term premia. In plain English, it means the world is charging the United States more for the privilege of borrowing, simply because the sheer volume of the refinancing treadmill has become a systemic risk. The Treasury is now forced to run faster just to stay in the same place. The silent exit of foreign capital is why the headline narrative of a robust, resilient economy feels so disconnected from the reality of the local bank branch. The liquidity is being sucked out of the system to fund the interest spiral. This creates a macro constraint where the Federal Reserve cannot easily lower rates to help the consumer without risking a complete collapse in the foreign demand for the dollar. We are moving from a world of dollar abundance to a world of dollar scarcity in the places that matter, even as the total supply of dollars continues to inflate. If you monitor the evening news or the official press releases from the Department of Commerce, the message is one of remarkable resilience. You will hear terms like robust labor markets and the successful navigation of a soft landing. This is the headline narrative, the carefully curated story designed to maintain public confidence. But beneath this veneer of stability, the global credit system is signaling something far more structural and concerning. The soft landing theory relies on the idea that the economy can handle higher interest rates indefinitely without something breaking. However, this ignores the refinancing treadmill we discussed earlier. While the average consumer may feel the sting of a 19% credit card APR, the institutional stress is concentrated in the very foundations of our financial architecture, the commercial banking sector. Receipt 3, a deep dive into the Federal Reserve H. 8 report, which tracks the assets and liabilities of commercial banks in the U.S. column, reveals the true cost of the $4 trillion debt load. As of early 2026, we are seeing a marked stagnation, and in some regions, a contraction, of commercial and industrial C&I loans. This isn't because businesses don't want to expand, it's because the marginal financing conditions have become prohibitive. Here's the part most people miss. When the Treasury is forced to issue trillions in new debt to cover the interest spiral, it effectively competes with the private sector for available capital. This is the crowding out effect in its final form. Banks, faced with rising duration risk on their existing bond portfolios, are tightening their lending standards to levels usually reserved for deep recessions. They aren't just being cautious, they are being squeezed. The headline narrative claims the consumer is resilient, but the H8 data shows that the liquidity backstop that usually supports small and medium-sized enterprises is drying up. The banks are opting to park liquidity in risk-free treasuries rather than lending to the real economy. Why? Because the yields on government debt are now so high that the official sector has become the primary competitor to the American entrepreneur. In the context of the reserve currency cycle, this is a classic symptom of fiscal dominance. The needs of the state to fund its $1 trillion interest bill have become so large that they are beginning to starve the private sector of the marginal financing required for growth. We are witnessing a transition from an economy driven by innovation to an economy driven by debt maintenance. This creates a dangerous feedback loop. As bank lending slows, economic growth cools. As growth cools, tax receipts stagnate. As tax receipts stagnate, the deficit grows even wider, forcing the Treasury to issue more debt, which further crowds out the banks. This is the macro constraint that the soft landing narrative conveniently ignores. Signposting this reality is essential. We are not in a standard business cycle. We are in a structural reserve currency transition where paper claims, debt, are growing exponentially faster than the physical settlement, the actual economy, can support. The mirage of the soft landing is simply the time it takes for the higher interest rates to fully penetrate the refinancing treadmill. The tension in the banking sector is a precursor to a shift in the global order. When the domestic engines of credit begin to stall under the weight of sovereign interest, the system inevitably looks for a regime change. History is rarely a series of random accidents. It is a sequence of mathematical inevitabilities. To understand the $4 trillion threshold, we must move beyond the 24-hour news cycle and apply a historical framework. Every dominant global currency, from the Spanish florin of the 17th century to the British pound sterling of the 19th, has followed a predictable reserve currency cycle This cycle consists of 4 distinct stages: expansion, overextension, fiscal dominance, and finally, multipolarity. In January 2026, the United States has officially exited Stage 3 and entered the terminal quadrant. This stage is defined by a shift from productive credit, where debt is used to build infrastructure and industry, to extractive credit, where new debt is issued solely to service the interest on existing obligations. The British Empire reached this exact inflection point in the late 1940s. While they technically won the war, the marginal financing conditions of their colonial debt became a macro constraint they could no longer outrun. The sterling did not disappear overnight. It simply lost its status as the world's liquidity backstop. Receipt 4. The data confirms this transition is already accelerating. According to the IMF COFR, Composition of Foreign Exchange Reserves report, the U.S. dollar's share of global central bank reserves has trended toward a critical threshold. While the dollar remains the primary medium of exchange, its role as a store of value is being actively diluted. For the first time in the post-Bretton Woods era, we are seeing the official sector in the global south and the east diversify into hard assets at a pace that suggests a lack of confidence in the long-term physical settlement of treasury paper. When the IMF COFR data shows reserve managers shifting even 1% or 2% of their holdings away from the dollar, it represents hundreds of billions of dollars in paper claims that must find a new home or be absorbed by the U.S. domestic banking system. In this stage of the reserve currency cycle, the refinancing treadmill becomes the primary driver of national policy. Every decision made by the Treasury is no longer about growth, but about systemic survival. This is what institutional analysts call regime change. It is the moment when the global credit system begins to price in the reality that the hegemon can no longer pay its debts in constant value currency. Historically, when a currency reaches this level of fiscal dominance, the official sector begins to prioritize the acquisition of tangible resources over digital ledger entries. This is why we see a decoupling of hard assets from the traditional bond market. In the past, a rise in treasury yields would lead to a sell-off in gold or silver. But in 2026, we are seeing both rise simultaneously. This is a broken correlation that signals the market is no longer viewing the treasury bond as a safe haven, but as a duration risk. We are now in the final quadrant. This is the period where the multipolar reality is no longer a theory, but a measurable shift in how the world settles its accounts. The interest spiral is the catalyst that forces the hand of every central bank on the planet, the true danger of the 38-ounce dollars. 4 trillion debt is not the total amount, but the velocity at which it must be rolled over. In the world of institutional finance, we focus on the maturity wall, the schedule of when existing debt expires and must be replaced. In 2026, the United States is no longer just running an economy. It is running a desperate race against the calendar. Receipt 5. According to the U.S. Treasury's most recent debt schedule, approximately 33% of all publicly held marketable debt, totaling over $10 trillion, is set to mature within the next 12 months. This is the refinancing treadmill in motion. The Treasury must issue new bonds at January 2026 rates to pay back the principal of bonds issued when rates were significantly lower. This isn't just a budget line item, it is a fundamental shift in marginal financing conditions. We are essentially witnessing the entire national debt reset to a higher cost basis in real time. But the pressure isn't just on the Treasury, it has fundamentally broken the traditional relationship with the Federal Reserve. Historically, the Fed acted as a profit center for the government, sending its surplus earnings back to the Treasury to help reduce the deficit. That era is over. Receipt 6, analyzing the Federal Reserve H4.1 balance sheet and the earnings remittances to the U.S. Treasury data reveals a stark reality. As of early January 2026, the Fed's deferred asset, a technical term for its cumulative operating losses, has reached a staggering $243 billion because the Fed is paying more in interest to commercial banks on their reserves than it is earning on its own portfolio of older low-yield bonds. It has zero remittances to send back to the Treasury. This creates a double drain. The Treasury loses a major revenue source exactly when its interest bill is hitting $1 trillion. To understand the spoken impact of this math, consider this. The government is currently adding debt at a rate of roughly $8 billion per day. That means every 24 hours. The national obligation grows by the equivalent of the entire annual budget of a medium-sized American city. We are adding a new $1 trillion to the total every 100 days. This creates immense volatility in the Treasury General Account, TGA, the government's checking account at the Fed. As the official sector pulls back, the TGA balances have become increasingly erratic, requiring the Treasury to flood the market with short-term bills to maintain its liquidity backstop. This is why we see physical settlement becoming a bottleneck. There's simply too much paper being issued for the system to digest without significant price distortions. Here's the part most people miss. When we talk about the $38, $4 trillion debt, we aren't talking about a static pile of money. We are talking about a living, breathing interest spiral. That is consuming the very institutions designed to manage it. The Fed cannot save the Treasury because the Fed itself is technically operating at a loss. The Treasury cannot save the economy because it is consumed by the refinancing treadmill. This is the macro constraint of 2026. The system has lost its shock absorbers. When every dollar of new tax revenue is immediately pledged to interest, the government loses its ability to respond to any new crisis. We are moving toward a point of physical settlement where the market will demand something more than just another promise to pay in a depreciating currency. As we navigate the fallout of the $38 $4 trillion debt threshold, we must move away from the headline narrative of certainty and toward the institutional discipline of scenario planning. The reserve currency cycle is not a straight line to collapse. It is a series of forks in the road governed by marginal financing conditions. Based on the current trajectory of TC flows and the exhaustion of the domestic liquidity backstop, there are three primary paths the global credit system may take over the next 24 months. Scenario A, the base case, the slow tightening. In this scenario, the refinancing treadmill continues to accelerate, but the official sector manages to avoid a sudden break. The U.S. Treasury continues to flood the market with short-duration bills, effectively kicking the can by shortening the maturity of the national debt. Historically, when a hegemon enters this stage of fiscal dominance, the result is persistent structural inflation. The government essentially uses financial repression to keep interest rates below the rate of inflation, slowly eroding the real value of the debt at the expense of the saver. Under a higher rate path, this means a zombie economy, low growth, high costs, and a steady decline in the dollar's purchasing power. Scenario B, the stress case, the liquidity shock. This is the funding stress scenario. If TIC flows continue to show foreign net sales and the primary dealers reach their maximum balance sheet capacity, we may witness a failed auction, a moment where there simply aren't enough buyers for the volume of debt issued. In this event, the marginal financing conditions would spike overnight. To prevent a systemic freeze, the Federal Reserve would be forced to abandon its inflation fight and move to yield curve control, essentially becoming the buyer of last resort for the entire Treasury market. This would provide a temporary liquidity backstop, but at the cost of a massive, rapid devaluation of the currency. Historically, when paper claims require direct central bank monetization to stay afloat, the market begins to flee into hard assets. Scenario C, the regime change case, the multipolar pivot. This is the most transformative path. Under this scenario, the persistent interest spiral leads to a formal policy shift by global competitors. As reflected in the IMF COFR trends, a coalition of nations, fatigued by the duration risk of the dollar, introduces a commodity-backed or gold-linked settlement unit for international trade. This doesn't mean the dollar disappears, but it loses its status as the reserve currency anchor. The global credit system pivots toward physical settlement, and the United States is forced to balance its budget through drastic austerity, as it can no longer export its inflation to the rest of the world. Each of these scenarios is conditional. If the official sector continues to divest, then scenario B or C becomes the primary path. If the Fed can suppress rates without triggering a currency flight, scenario A persists. However, regardless of which path is taken, the macro constraint remains the same, the interest on $38. $4 trillion cannot be paid through organic growth alone. The question for the sophisticated investor is no longer, will the system change? But how will I be positioned when the physical settlement of these claims is demanded? The transition from paper claims to physical truth is the final act of the cycle. The final stage of the reserve currency cycle is always characterized by a return to reality. In institutional terms, we call this the transition from paper claims to physical settlement. Throughout this briefing, we have tracked the $38, $4 trillion debt, the $1 trillion interest burden, and the tightening of marginal financing conditions. But there's a finite limit to how many digital entries a system can support before the holders of those entries demand something tangible. We have reached the physical cliff. For decades, the global economy has operated on the assumption that U.S. Treasury bonds were as good as gold. They were the ultimate liquidity backstop. But as the interest spiral becomes unstoppable, the world is beginning to realize that while the supply of paper is infinite, the supply of high-grade industrial and monetary commodities is not. Receipt 7. When we look at the flow of physical silver and gold, we see a macro constraint that no central bank can print away. Over the last 24 months, institutional reports show a massive migration of physical bullion from Western vaults to Eastern central banks and private exchanges. This is the ultimate hard receipt. While the paper price on the COMEX is often suppressed by marginal financing conditions and speculative shorting, the physical premium for actual delivery is telling a different story. This is the part most people miss. The $38. 4 trillion debt is a paper claim on future production that the physical world cannot possibly fulfill. If even 1% of the holders of U.S. debt decided to exit their positions and move into physical silver, the silver market would experience a physical settlement failure almost instantly. The ratio of paper claims to physical ounces has reached a point of mathematical absurdity. In the 2026 landscape, silver isn't just a metal, it is a refuge of truth in an era of fiscal fiction. It is the only asset that sits entirely outside the global credit system. It has no counterparty risk, it cannot be rolled over at a higher interest rate, and it is not subject to the refinancing treadmill. As the official sector continues to lose confidence in the USD's store of value function, the pivot to hard assets becomes a matter of national security. We are standing on the edge of the cliff. On one side, we have an interest spiral that requires the constant creation of more currency. On the other side, we have a physical world with finite resources. The bridge between the two is collapsing. Historically, when the reserve currency cycle reaches this quadrant, those who hold the physical assets are the ones who define the terms of the next regime change. The physical cliffhanger is this: the Treasury can print more bonds, the Fed can print more digits, but neither can print more silver. As the marginal financing conditions continue to break the banking sector, the demand for physical settlement is moving from the periphery to the core of the global financial system. The math has already been decided. The only remaining variable is time. In our next briefing, we will look at the specific bottleneck receipts, the actual tonnage of physical metal remaining in the system versus the trillions in paper claims currently seeking an exit. In the reserve currency cycle, the math never lies. It only waits.